why you keep losing money in the stock market.
To win. It's designed to transfer your money to those who understand its true nature. And what if everything you've been told about investing is actually engineered to make you lose money? In the next 10 minutes, I'll reveal why 90% of retail investors consistently lose money, expose the hidden forces that manipulate retail investors, and share the simple mindset shifts that separates the winners from the losers. Now, for you to get the maximum value out of this video, there is also a free workbook for you to download at felixfriends.org/stop losing. Links down below in the description. Felix here, and as Warren Buffett once said, the stock market is a device for transferring money from the impatient to the patient. And if you've ever wanted to protect your hard-earned saving from the noise and hype that plagues the market, pay close attention and take notes. You see, retail investors like you and me constantly face a barrage of headlines, social media hype, and market gurus whose advice is designed more to profit from your next move than to guide you towards success. Take Alex, for example, a 25-year-old investor who saw a TikTok short touting a penny stock as the next Tesla. Alex invested his savings on the promise of a meteoric rise, only to watch the stock nosedive when the hype evaporated. And this scenario isn't isolated. Many retail investors are caught in the crosshairs of manipulated sentiment. Yet the impatient often hear nothing but noise, a cacophony of opinions, hype, manipulative narratives delivered by those who have little genuine expertise. And this video exposes that noise and provides a guide to thinking critically in a market fueled by emotion and manipulation. Now, I've spent countless hours, and yes, even my own money, learning from my mentors, hedge fund managers, market makers, guys who've been trading for 30, 40, 50 years. And I've been studying the market patterns with them and learning from them to bring you this information. And I'm not just giving you the basics here. You'll notice I'm going to dive straight into the heart of the matter. So write this down right now. The stock market is not a casino. And understanding the forces at play gives you control over your financial future. And if you're wondering if this applies to your situation, it absolutely does. And if you only learn this one concept here today, you will already be ahead of 90% of retail traders. So stay with me because I'll reveal the exact formula later. But first, we need to understand and explore the reality of noise-driven markets. And I hope by the end of this video, you'll have the tools to navigate the market with confidence, just like my adopted golden retriever Winston, who sniffed out all the research for me. At least he drools on it. So let's get started on your journey to becoming a savvy investor to navigate this tricky market. So we've established now the reality of noise-driven markets. Let's dive deeper into the anatomy of market disasters. You see, the forces that lead to financial losses are not just external, they often stem from our own behavioral biases. And you might be wondering, why do I keep making the same mistakes? Well, it's because behavioral biases like overconfidence, herd mentality, and loss aversion plague retail investors like you and me. We hold onto a declining stock too long, hoping for a turnaround, while selling the entire winning position too early to lock in gains.
And this is so true. How many times? Okay, put a 1 in the chat if this has happened to you, or a 2 in the chat if you've managed to somehow sidestep this super common thing. Put a 1 in the chat if you have been in a situation where you put on a trade and you're like, yeah, this should work out, right? Keyword there. This should work out. This should be a great trade. And it turns around and, of course, immediately goes against you. And you're like, well, I can't sell now. I'm losing money. I'm not gonna sell now. So I'm just going to be a long-term holder. I'm just going to be a long-term investor. You guys are putting in 1 before I've even finished, but you must know what I'm saying. I'm just going to be a long-term investor here. I believe in the company. I like the CEO. I think that this company has legs. Just wait till the next earnings call, right? All these different things that you can come up with to say it has to go, it should go up. And by God, I am not going to sell out of this stock until it goes back up and gets to break even, right? And that's what he's talking about here, is that this is so common, right? And clearly I'm not the only one who dealt with this. Yeah. Super, very common. And Knight says, I'm just rubbing salt in my wound. And it might remind him of other channels. It might remind him of other channels. KX says, that's my whole portfolio. Yeah, dude. Yeah. I suddenly became a long-term investor. Right. This is super common, right? This is super common. So I'm curious to hear what Felix has to say about that.
And if that's something that resonates with you, write in the chat. Just put a 1 in the chat, and that way I know that this is landing for you. This
Felix must watch our videos. There's no way that he would have come up with the exact same thing that I said 12 seconds after I said it. That is so funny.
Reactionary behavior, known as the disposition effect, is very well documented. When faced with fear or greed, we often make decisions that guarantee losses, as the market rewards those who remain patient and thoughtful. But it's not just our own biases that lead us astray. The media and social media play a significant role in amplifying these mistakes. We're bombarded with sound bites and clickbait. Social media platforms like Reddit, TikTok, and X have this gravitational pull, drawing us towards the latest meme stocks without a second thought. Remember the GameStop saga? Retail investors jumped on board just based on buzz rather than fundamental analysis. Their decisions, driven by FOMO, fear of missing out, accentuated the volatility and uncertainty that becomes profitable only for those orchestrating these trends. I have friends who run hedge funds, and they were like, this is the most profitable thing we've ever traded. GameStop. Right? But this isn't just about individual cases. It's a systematic issue. Financial headlines are often engineered for clicks and impression rather than reasoned analysis. Influencers profit from their reputation, even when they provide advice that blurs the line between, well, genuine analysis and pure speculation and maybe just the occasional backhander. And recent financial research, there's a 2024 study published in the International Review of Financial Analysis. I know you're a subscriber. And it analyzed trading data from users heavily influenced by the Wall Street Bets subreddit. And it confirms the danger of this echo chamber. The findings were stark. WSB, short for Wall Street Bets, attention didn't lead to smarter trades. Instead, it spurred uninformed trading, with decisions more likely driven by emotional responses to angry and disgusted posts than by actual financial analysis or even...
Oh, that's so useful. Let's go back. Okay. So listening to other people's noise caused more people to take uninformed trades. This makes so much sense to me, right? Imagine you've got CNBC playing over here, you've got the Joker channel playing over here, and on your third monitor, because we all need 12 monitors, right? We all need all these monitors, right? No, I have two. Two is the most you ever need. On this other monitor, you've got, I don't know, Wall Street Bets, right? So you got Wall Street Bets, you got the Joker, and you got CNBC. All three are screaming at you. Oh, this is the greatest stock ever. This is the one to buy. This has to go up from here. $75 in this one stock will make you a millionaire, right? Tom Lee says this is the best investment of all time, right? All the trite things that are played out, which of course I use for clickbait. All of that to say, all of that led to more uninformed trading, not more successful outcomes. And the emotional responses, let's just skip here just for a moment.
Emotional responses to angry and
and the emotional responses turned to anger and disgust on those two things, right? So you will be able to see, in fact, you can go back and see every one of my trades I've ever made over in our Discord. And you can follow along with me when I trade. And you can also follow me when I go to cash, which is a trade as well. But I never want you to feel like I am leading you down a path to take a trade that you wouldn't take otherwise. Because what is the number one thing I say when someone asks me what to do? It's, what was your plan? What was your plan? I have my plan. I know what I'm going to do. But I am not going to be your financial advisor. No. I am not going to be your trading guru. No way. I am not going to let you copy trade me or whatever weird stuff they do. You can choose to follow along with me or not. I'm going to teach you how I trade. I'm going to show you the trades that I make. And if you want to follow along, by God, let's go. Let's do this. But know where your risk is at. Okay? Uninformed trading has led to so many people blowing up their accounts for no other reason than, I don't know what to do, so I'm just going to listen to that guy. Right? That's the last thing I want you to do. I want you to become an expert in the markets like I am. Right? I love this game. Some people love playing golf. Some people love to go to the gym. I love to go to the gym. I've learned a lot about the gym, but that's not where my passion lies. My passion lies in the stock market. I love the stock market. And you can probably tell from my content, this is my thing. And if it's not your thing, that's okay. But I want you to be in a place where you are making your own informed decisions. You're not listening to outside forces, and you're focusing in on the very most important thing. The one thing that'll make you or break you at the end of the day. And that's that only price pays. You can have all the best reasons in the world why the stock should go up. But if the price isn't working for you, you have to turn around and you have to get out as fast as you can. You have to.
Disgusted posts than by actual financial analysis or even sort of traditional advice. And this hype-driven trading led investors to take on riskier stocks and allocate...
I'm going to go ahead and pause this just for a moment. Shoei asked a fantastic question. Chris, how does a novice make a plan? I'll tell you exactly. So first, Shoei, let me ask you, have you kept up with the trades that you've made over the last couple of years? When I say kept up, I mean, like, you can go back into your broker statement and you can see all your entries and all your exits, but did you keep up with them, right? So that's where I would start, is I would actually go to my broker statements if I didn't already have a list. And I would say, okay, on January 1st, I bought Meta stock. Then go to the Meta chart and say, okay, on January 1st, Meta stock looked like this, right? Let's do that together. Okay, let's do that together. Let's do that together, Shoei. I'm here for you, my friend. All right, so January 1st. January 1st. Let me get to January 1st. Well, of course, not January 1st, January 2nd. January 2nd, I bought Meta stock. On January 28th, I sold Meta stock. Okay. So now, Shoei and everyone else listening, what happened between those 2 points to you, right? Where was your mental game at here between points A and B? Did you get in because you heard somebody say on Wall Street Bets, or maybe somebody on CNBC say, Meta has to go up from here. This should be the bottom. Meta must go up from this point. And you got in a couple days later, you're like, oh, of course it is. Yeah, of course. And you got this one candle and you're a little bit fretting it, but then the next day it went up, and it went up for a while after that. You're like, okay, all right, cool. Well, then what happened between A and B? What caused you to sell at that point? Was it because earnings was the next day? That would have caused me to sell. Was it because you felt like you had hit your profit target? Where did you get that profit target from, etc.? Point being is, I would go back and I would start with your trades. I would plot them open and close. And then I would try to remember at the time, what did I see that got me interested in this? What did I see that got me out of this trade? And then start developing it from there. Because I'm telling you, that's what I did. And that's what I would do if I were starting over again. And that is what I do when I make my trading journal. Is I see, this is where I got in. This is all the data points that I need to see, whether it's the outlier buy and sell signal, whether it's the fear and greed value, whether it's in a trend, all that stuff, right? Figuring out everything that I need to know so that I can go back and look at it and say, you know what? That seemed to work well when I had this thought process. Let me see if another one had that. Oh, okay. If I bought emotionally, or if I bought listening to CNBC, it didn't turn out that well. So that's where I would start. And that's a fantastic question. I really appreciate, Shoei, you asking that.
Larger portions of their portfolio to these volatile bets, resulting in significantly negative returns, which is a very polite way of saying they lost their shirt and their socks. The average position opened during the Wall Street bets frenzy was a 9% negative return, which is pretty horrible considering how much the market was rallying during that time. And the study also linked this attention to classic speculative behavior, shorter holding periods, rapid buying and selling, rather than reasoned investing. And when you combine this with the potent social media noise and low commission trading apps, the situation becomes even more precarious. You see, while democratizing finance sounds appealing, the design and features of many platforms, I'm not naming any here, like Robinhood or something, I'm not thinking only about that one, I think I got away with that, they act as an accelerant for bad decisions often. Zero or near zero commissions, one-click trading, it removes the natural barriers and moments for reflection, making it incredibly easy to act impulsively on a trending hashtag. There is one great piece of advice I got from one of my mentors, old coach who'd been trading for like 30 years in Chicago. And he said to me, he calls it the 24-hour rule. When you have an idea, something you want to invest in, something you want to buy, give it 24 hours from the moment you have the idea to actually execution. And it works really well. And I actually know some people who've extended that to 48 hours. And it just gives you that time for reflection. You sleep on it, and the next day you're a lot less excited about it. And often you think, probably wasn't the most brilliant of my ideas. Moreover, gamification and attention hijacking features like push notifications about stocks on the move, and point systems, confetti animations after trades, or trending lists, all that stuff is designed for engagements, right? They can turn investing into a game, hijacking your attentions and prompting you to take action based on excitement or FOMO, not strategy. And the apps provide the perfect environment for increased trading intensity and short holds, like in the WSB study. And let's not forget the illusion of simplicity. Now, user-friendly interfaces are great, but sometimes they can oversimplify risk or make complex derivatives like options and speculative bets seem trivial, leading inexperienced investors into deep water without realizing how deep the water is. Here is the crucial question you need to—
I totally agree with that. In fact, if you guys remember, there was a kid who actually offed himself a few years ago because he didn't understand the options trade that he put on. He was assigned shares. It turns out it would have been fine because he was assigned the short shares to cancel it out, basically. He would have had a loss in the trade, but he thought he was going to be out like $600,000, and he offed himself because of that. I actually interviewed with Robinhood, the platform, multiple rounds of interviews to see, who would be the lead trading educator for options. Ultimately, they went with someone else, but like that was a big deal to me. It's like you guys empowered this person to be so stoked to trade options, yet he had no idea what he was doing, clearly. And then he's gone because not only did he have no idea what he was doing, but he didn't even realize that he was okay. That's a sad story. That's a really sad story. And I would hate for that to ever happen again. So if you are going to trade, I think it would behoove you to figure out what you're doing before getting in, right? I'll try and explain everything as I go, but that doesn't mean you're going to understand, right? Just because I say buy a deep in the money, that I'm going to buy a deep in the money long call on Meta, that is the right thing for you. No way. I would tell you to do your own diligence, figure it out if that is right for you.
To ask yourself, is this platform, the one you're trading on, designed for my long-term wealth creation? Or is it designed to maximize the revenue through trading volume, payment for order flows, or other means for the owners of the platform? Right? The easier and more fun they make it to trade, frequently on noise, the more likely you are to fall into the losing patterns that we've seen in the research. This environment makes it absolutely critical to build your own skills and emotional discipline. You cannot afford to be a passive recipient of platform nudges and social media storms. And that's why in the next section, we'll explore contrarian investing solutions that can help you navigate this treacherous landscape. But before we move on, let me ask you this. Have you ever found yourself caught up in the hype of a trending stock only to regret your decision later? If that's the case, write regret in the comments down below and I'll see it. And if that's also you, might want to write down in your notebook the following. I will not let my emotions or the noise of the market dictate my investment decisions. We've explored the anatomy of...
That's actually pretty good. That's actually pretty good.
Let my emotions or the noise of the market dictate my investment decisions.
I think that's really good. I will not let my emotions or the noise of the market dictate my investing decisions. Now, there's a lot of noise in the market, especially in the YouTube space. And there's a lot of people who buy these stocks and just hold them as they go down and down and down and down and down. And they try to convince you that you are the dumb one because you haven't bought AMD yet, right? AMD, that's been going down for practically since Noah's Ark, right? Practically since Noah was in his Ark. And they're trying to tell you, now you've got to buy AMD. If you haven't bought AMD already, you are so dumb. That's the funny part to me, right? As things are screaming towards the Gulf of America, they're trying to tell you, why haven't you bought this yet? You're so dumb. You should have bought Elf Beauty already. Haven't you seen what a great buy this is? Oh my gosh. Yeah. Don't let those emotions dictate your investment decisions.
We've explored the anatomy of the market, and that was important. Now it's important to discuss the antidote to the noise. You see, the key success in the stock market is not following the crowd blindly, but thinking for yourself. And that's where a critical, skeptical mindset comes into play. Contrarian investing is all about resisting the urge to follow the herd. It's about buying when others are fearful and selling when others are greedy. And let me tell you, history is littered with examples of those who have profited from this approach. During the 2008 financial crisis, for instance, savvy investors purchased stocks of fundamentally sound companies at deep discounts. Those who had the strength to question prevailing market sentiment reaped the rewards in the long run. So what are the key principles of contrarian investing? Well, first, you need to focus on fundamentals. We look at charts in a moment, but fundamentals will be the first thing here. So instead of chasing this random trend, look at the actual intrinsic...
I'm really surprised that Felix said focus on fundamentals. I'm just going to put that out there. I've watched a lot of his videos. Bro, he might look at fundamentals. I don't know if he actually does, but he's very much a price action trader, as am I. And your fundamentals aren't going to pay you anything. You could have the greatest earnings report. You could have the most EBITDA. You could have the fantasticest, right? The most huge transactions on the planet. Our market share is growing hand over fist, and because we're selling everything to China, right? We have sold everything to China, and our stock price must go to the moon, right? Oh wait. I like to use those kind of examples because it's like people can get caught in the hype of fundamentals, which only come out once a quarter. The fundamentals, the numbers come out once a quarter, and yet you're basing your investment decisions, your trading decisions on data that comes out once a quarter. What are you going to do with the other 89 days a quarter? I don't know. I would say probably follow the outlier trend template. That's where I would start, right? With the 10 over the 20 price over the 50. That's where I would start.
Fundamentals would be the first thing here. So instead of chasing this random trend, look at the actual intrinsic value of a company. A healthy balance sheet, sustainable profits, robust competitive advantage matter far more than today's hype. Second, see where we are in the market. What's the sentiment out there? There are tools like the VIX, the volatility index, that can tell you whether we are fearful. Anything above 20 is fearful, and anything below that, you're pretty much okay. And thirdly, discipline and patience are crucial. The market is a marathon, not a sprint. Successful investors.
Discipline and patience are crucial. Yeah. And patience to like sit in cash, the discipline to sit in cash, the discipline to wait for your slides to load. And then I always say, Richard Dennis, he was the one who created the Turtle Trader project. He had made $290 million by the time he was 29 years old. And he says, I always say I could publish the rules in a newspaper and nobody would follow them. The key is consistency and discipline. Somewhat like what Felix is saying right here. Discipline and patience are crucial.
Investors often draw parallels with long-term investing. The best investment decisions require time to play out and patience to avoid panic selling. So write this down right now. I will not let short-term fluctuations in stock prices dictate my long-term strategy. And finally, always prioritize risk management.
Yeah, again, this doesn't jive with the videos that I've watched of his before. But okay.
You want to use stop loss orders and maintain a somewhat diversified portfolio. Every single position you have, in my humble opinion, deserves a stop loss order. Because why do we get into a position? To take profits. So if it goes up and we don't take profits when it comes down, then we start at zero again. What would possibly be the benefit of that? So what about that?
Yeah, the prioritizing risk management is so critical, right? Tesla is exactly one of those examples where it round tripped this incredible, it was up 120 something percent, I think, from this bottom to this top up here, 120% move that a 100% evaporated, right? And you could have avoided this entire whipsaw, kept all the way up gains, kept the gains all the way up, got out, maybe not the very top, but decently close to the top, and then avoided this huge stretch back down. If you had only 40% of the hair on your head, like I do right now, you probably wouldn't have any left by the time that ended.
Critical, skeptical mindset we need to develop. Well, in a world filled with misinformation, if I may have used that word, a healthy dose of skepticism is your most valuable asset. Retail investors like you and me must learn to question headlines, social media trends, and the advice of market gurus. Look at what people are doing, not what they are telling you to do. Lovely example is Warren Buffett. He always says, put all your...
Hey, tell you what, yeah, I'm telling you, and I'm doing whole cash. One of my sayings is stay in cash and don't F up. If you don't have any reason to put on a trade, stay in cash and don't F up. And sometimes it's really hard, Theo. It's really hard, Theo. I get it. He didn't have the discipline to stay in cash and he bought the dip. And I hope you don't mind me calling that out. But you typed it in for the whole world to see. So I wanted to mention it. It's really difficult sometimes, dude. I totally get it.
Your money into index funds. He doesn't own any index funds, right? Go figure. So what are the hard questions you should be asking? Well, first and foremost, who benefits if you follow the advice? Is the information coming from a source with a potential conflict of interest? And most importantly, what do independent metrics tell you? Now, one reason on this channel, you will never see an endorsement or a sponsorship or any kind of payment from anybody out there, whether that's a brokerage or a stock, is because I strongly believe that I should avoid those kind of conflicts of interest. I also don't want to endorse stuff that I don't really understand, so I never do. Let me give you a real life example. Imagine Sarah, mid-career professional who once invested in a can't miss opportunity touted by a popular influencer. We shan't name names. Now, only after a significant loss did Sarah learn that the influencer was compensated for recommending the stock. And by questioning the source rather than accepting the narrative, she could have avoided the trap. So what are the actionable steps for developing that skepticism? Well, first, verify with other sources that are more independent. And hard to come by independent sources nowadays, so you got to look at a couple of them, right? Compare information across multiple publications. That's what I do. And don't just take one person's word for it, especially if they might have a vested interest in your decision. Secondly, do look at fundamentals. Spend some time learning basic financial principles, and we've got free programs on that. Literally, if you go into my education,
I 100% disagree. I'll tell you one thing. I don't know a single PE ratio of any stock out there. Not one. I don't know a single revenue growth percent historical of any stock out there. Because it doesn't matter. But those fundamental numbers are absolutely meaningless. I'm very surprised that he's talking about that. Maybe he's talking about learning the fundamentals like you learn the fundamentals of soccer, right? When you learn the fundamentals of soccer, you gotta, first fundamental is you got to use your feet, not your hands. Second fundamental is you want to get the ball in the goal, right? Those are fundamentals. And maybe that's what he's talking about. Learn the fundamentals of the market, not necessarily learn the fundamentals of the financial results of these stocks over time. I don't know. But to that point, I agree with him. I agree with you need to understand the market and the movements, not necessarily the fundamentals of the company.
Playlist, there are full-length programs which teach you all those basic principles. And trust me, the time you invested in learning that will save you so much money. It's a phenomenal return on your time spent. And finally, reflect on your personal biases. Acknowledge your innate biases and actively seek contrary evidence. So look at people who disagree with you and then think for a moment, could they be right? Because the market rewards those who remain patient and thoughtful, not those who act on impulse. And then ask yourself this, have you ever followed some market guru or trend only to regret it later? Again, put it in the chat, right? Regret in there, right? There is a lot of regret, but we can learn from that. We can use it as a motivating factor. Stay with me because on the next section, we're going to explore the path forward and how you can apply these principles to your own investment journey. So as we wrap up our journey here, it's clear that success isn't just about what you do, but how you think and approach the market. To thrive, you must embrace patience and disciplines. Wealth building is a marathon, not a sprint. It requires some effort. And it requires the ability to resist impulsive actions driven by noise. Keep your eyes on the prize. What does that mean? It means you actually need to have a target. Why are you doing this? Is it you want to retire earlier? Is it you want to travel? Do you want to pay for your children's college? Or whatever it might be that drives you. You got to write that out. You got to be clear about that. Like you got no flight plan. You don't know where the hell you're going. You're just going to go around and around and around, right? And then you look at a company, focus on the underlying business and the documented performance. Spread your investments across different sectors to protect against unexpected stuff happening. Right? If you're all in on AI, well, what if it doesn't work out? Right? You're in trouble. You don't want to do that.
This I can agree with. I agree with that for sure.
You might have worked 20, 30, 40 years of your life for this money and you put it all in the portfolio and then you put it all on red, right? That's just not really what smart, reasonable people do. Spread it out. You'll do much better over time. Remember, the market evolves, so you must evolve with it. So buy and hold forever doesn't really work when the crowd rushes in. Yes, we can benefit from that. And we've got some really cool momentum rules on that. But take a step back to reflect and analyze. If everybody's loving it, maybe it's time to take profits. When everybody hates it, the fundamentals are good. Maybe it's
right. We've all heard the shoe shine boy story, right? Where it's like, you go, I don't know who gets their shoe shines anymore, but maybe let's name this the Uber driver story, right? We all have heard the story of somebody who gets in their Uber. And the Uber driver is so excited because he's like, hey, I just bought this stock. I'm making so much money on it, right? Right there is the top. Right there is the top. That's when you know the enthusiasm, the unbridled animal spirits have come to roost when you hit this point up here at the euphoria point or the thrill point where people are so stoked that you've never even met this person before, but they're giving you stock advice. That's generally the top. That's generally the top. And you've probably experienced it as well. So let me introduce myself. I know I am just some random guy on the internet, but my name is Christopher Ewell. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. And go ahead and head on over to OVTLYR.com, and let's talk about that real quick. So we are releasing Outlier 3.0 this week, and to celebrate the release of Outlier 3.0, we want to give you $1,000 and a full year of Outlier on us. That's the grand prize. And we already have 7,308 entries so far. How cool is that? You have 17 days left to enter. All we ask is you share a handful of things, like watching a couple of videos, sharing a couple Twitter posts, maybe leaving us a review, and tagging us on Instagram, stuff like that. And some of these you can do more than once a day. But there are some secret codes, and I don't have any more secret codes. If you missed out on the secret codes, check out last week's videos. Maybe you can capture one of them, because the secret codes, those have come and those have gone. Let's see who's leading right now. Deep Thought somehow has hacked our servers and has 237 points. I don't know how Deep Thought has done this, but he has hacked us. Nikolai B also has hacked us at 187 points. So I don't know what you guys are doing, but I like your odds. And if you want to make sure that you win $1,000 and a free of Outlier, be sure you head over to outlierdeal.com. The drawing will be on May 2nd, ending midnight May 1st. And first runner-up gets $200 worth of free merch and my 5 favorite trading book bundle. And second runner-up will get $150 worth of free merch and my 5 trading book bundle as well. So be sure you head over to outlierdeal.com today. Now let's continue on. with my PowerPoint. There we go. Oh no, that was a secret code from last week. Oh, but what day was it on, right? Okay, so question for you is, what did we learn from Felix's video? What did we learn from Felix's video? This is what I want to see. This is what I want to see. What did you learn from Felix's video? If I had to talk about what I learned in this video is I really liked how he had receipts about how people taking Wall Street bets, Reddit trades, listening to other people on the internets, me included, have actually had worse results because of it, right? Now, it's very possible that you follow me into a trade and then I get out and you don't even know. That's very possible. But I put all of my trades in the Discord. And I know some of our traders actually set alerts specifically on this one Discord channel. This Discord loads. Which is the Outlier Trading Room channel. Now, only admins have access to this. And there's me, random guy, right? Only admins have access to this. So you're only going to see my trades and maybe something from Mark or Mahesh on here. But you can follow me along in there. And if you do get into a trade, because I get into a trade, know this, right? I'm not your financial advisor. I don't know how big of a trade you're putting on. I'm not saying you should put that trade on. And if you're going to get out of the trade, you need to know where you're going to get out. You need to know where you are going to get out. Having a plan is what separates the best from the rest. Iceman says, I can't win. I don't have social media. Well, then go create one. They're free, right? Like a PE ratio over 80 equals greedy, right? If you learned that today, you learned more than I did. Alana says, don't listen to the noise. That's a really, really good answer. I think that's kind of the winner of the day for sure. Don't listen to the noise out there, including me. So it's your choice. Be lame or don't listen to the noise and change your life. That's your choice. Now let's look at today's member highlight over in our Discord. A couple of questions came through on the Discord that I'd like to answer. Questions from you. Let me scroll up a little bit. Okay. So Helpless Kid asks, let's say you set yourself a max of 10% of your portfolio size for a single trade and all of your signals align. Would you allow you to make 10 trades simultaneously? Would you basically go all in on those 10 trades? Yeah. I mean, that seems like the math. If you have 10% of your account, you have 10 trades that line up, you take all 10 of those, you're full in, right? And that can happen. That's happened to me many times where I want to get into more trades, but I have actually used up all my capital. So what do I do in those situations? I follow my plan, right? I don't like FOMO into something else and saying, oh, but this looks so much better than this one. No. I have my reasons to get in. I have my reasons to get out. And in the meantime, sit in cash and don't F up. But it's a great question, right? Would you go in all 10 trades? I would personally, because that's what my trading plan would have given me. Thomas says, watching your exit strategy bullets, you seem to be very conservative. For sure. In fact, let's go through those real quick. My exit bullets are the 10 EMA being broken or a half ATR from entry. So what does that mean? So the 10 EMA would be, here, we'll use Tesla right here. The 10 EMA is the blue line. So if price ever closed below the 10 EMA, like on this candle right here, that would be an exit strategy for me. And the way that it follows up price is called a trailing stop because it trails up behind you and it'll tell you when to get out. And would have been a great time to get out, by the way. But remove this. Let's say that I got in here, just as an example. I'm not saying I did or would have, but let's say I did here. Then I set a half ATR below here. This would be my initial stop loss. Now, I saw Senior Wahoo had a question on the stop loss. Let me go up to his question real quick. Not an easy way for me to search through these. Trailing stop loss. Okay, there it is. If you're using a stop loss, do you use a dollar amount or fixed percent? So I use a half ATR, and a half ATR can change on every stock, right? So for example, Tesla, at this point in time, the ATR value, which is the volatility of that stock, the average true range over the last 14 candles was let's call it 12.8. So half an ATR would have been 12.8 divided by 2, 6.4. Okay, so I would have gone down $6.4. Okay, something like that. But as you can see, that expanded. So now up here, it was at 23. It went from ATR of 12 up to an ATR of 23. So it doubled. So that ATR value doubled by the time I got over here. So rather than saying a fixed dollar amount or fixed percentage, by using half an ATR or a variable or a number that can vary based on the volatility of the stock, can keep you in when the stock is less volatile and get you out if it becomes more volatile, or vice versa. You can get out of the stock as it gets more volatile and you need to be trading smaller, or keep you in and trading a bigger position when the volatility is smaller. So it's a great question for both of you guys. Let's go over here. I'm not questioning that, but you always say drop your losers and let your winners run free. Actually, what I say is cut your winners short and let your winners run out of control. But on the other hand, you do not let it become too greedy. Yeah, thinking about your 50 to 75, 75 plus for sure. Yeah. And so this is numbers that I had back tested. And then, of course, with Outlier 3.0 rolling out really soon, these are going to be completely redone with new. I am very sure that I'm going to have new numbers here to say where is too greedy or too fearful for me and what that spread would be in the fear and greed. So that will be changing pretty soon. And then, of course, let's go over to the share your big wins here. And this will the winners will be announced Thursday of this week, right? Carol Catherine's talking about the music she used for that song we played at the very beginning here. Super, super cool song. What else? Oh yeah, here we go. Chris would not like this, but I did a butterfly and iron condor on Nvidia, did the deal, and held post-Trump gains, held post-Trump pumps negative 42%. Positive, not negative. Okay. Either way, that's awesome. So be sure you continue to share your stories in the Discord, right? We want to hear from you and how you are using Outlier. And of course, the first rule of Outlier, you should tell everyone about Outlier. You tell everyone about Outlier. And of course, you hit the like button. Now, let's go see what the market is telling us. Well, actually, let me do this real quick. What is Outlier and how does it work? Well, Outlier tells you if investors are acting irrationally fearful or greedy and by how much, which allows you to get into stock before the Outlier move happens. And if you're ready to save time, make money, start winning with less risk, be sure you head on over to outlier.com and get the annual pass to save 64%, which is just 82 cents a day. And if you're on the monthly plan, you can upgrade with just one click. Now, let's go see what the market's telling us, right? What is the market telling us today? I've been telling you for a minute. I think the market may have bottomed. Let's go see why. So first off, now this is all if Trump doesn't mess it up. All if Trump doesn't mess it up. First off, we've seen the market accelerate its downward slide, push down hard, and then what we see right now is it seems to start to be pushing back up. We've got a couple bullish order blocks down below it, and let's look at the EMAs, the exponential moving averages. The 10-day EMA is an indicator of the short-term trend. We just had two closes over the 10 EMA. So it looks to me like the short-term trend is starting to go up. Well, in fact, the short-term trend is up. In fact, you can see the 10 EMA is now curling upward towards the 20 EMA. And then let's look at market breadth. Market breadth has really helped us a lot lately. So market breadth measures how many stocks are on our bull list versus our bear list. We have 46 new buy signals today versus just one new sell signal today. So we got stocks like Digital Turbine Inc. We've got Canadian Pacific. We've got Driven Brands, and we've got Fluence Energy as different buy signals, with the only sell signal today being Planet Labs. So if we look over at market breadth, this is how we measure how many stocks are on the bull and bear list. And you can see here that the market breadth has bottomed and is starting to turn around. In fact, we have a bullish crossover today on market breadth. So we have a bearish trend, but we have bullish market breadth today. And the market breadth, in my opinion, has been a really strong leading indicator for us, a very strong leading indicator for us. In fact, before this move up right here, which happened the last time we had this crossover, I said, I think we're about to have a short covering rally, which happened March 10th. When did this happen? March 13th, 14th, 15th, all of that started right after that point. So I'm very confident that we could be seeing the bottom put in right here. Will we shoot right back up? I don't know about that. But the 10, 20, 50 is still crossed down. Give it a few days, give it a little bit of time to work, and give it any politicians that want to make things crazy. Then I think we actually might be ready for another setup for new bullish stocks, which I'm very excited about. I'm sure you are too. So let's see. No trade setup for me today, but that's all right. I'm actively looking every single day with consistency and discipline. So, of course, tell me what you're trading in the chat. And if you're an influencer of any size, we want to work with you. Shoot us an email over at support@outlier.com. And be sure to come back tomorrow where outliers like us will save time, make money, and start winning with less risk together as a team. Now, YouTube is going to pop up a couple recommended videos. I recommend you watch one, and I recommend you have a fantastic day. We'll talk soon.